It's been a roller coaster ride this year with the unpredictable market and rising interest rates. Our Jennifer Jordan sits down with Jim Lineweaver to talk about strategies to protect your bottom line.
Inflation is lower, but still with us. With the markets down for the year, financial planner, professional, and host of the Financial Quarterback here on Fox 8, Jim Lineweaver is here with us this afternoon to give us some insight into your portfolio. Jim, thanks so much for joining us.
It's great to be here. Thanks for having me.
Thank you so much. Well, first of all, my first question for you, we've seen markets volatility this year, right? And the markets are down for the year. Part of that can be attributed to rising interest rates. Is that right? And which are supposed to be helping out with us, to help curb inflation. But this is a challenging mix for retirement savings, if I'm correct. And so what should people at home be considering when it comes to their savings?
It's been a real volatile year, right? So when you say the markets are down, actually all the major indices went into bear market territory this year, which means down 20% or greater. So you had the Dow, the S&P, the NASDAQ. Even the bond market got close to bear market territory this year. So, and that hasn't happened in almost 50 years.
Wow.
So a lot of volatility in people's portfolios. When you talk about retirement and their savings, people are wondering, what should they do because of the volatility in the market. You don't necessarily associate your savings and want to dump it into something like that can be so volatile.
Right. So you always say that there are always opportunities out there, even in challenging markets. So what kind of opportunities are you sharing with your clients right now?
Well, some of the great ones today, especially if you have savings sitting there not doing anything, because if inflation's high, your savings isn't really making anything, you're technically losing money, even though you don't see it on paper. So right now, with the rise in interest rates, you can actually go into FDIC-insured CDs, and you can go anywhere from 3 months to a year and get maybe 4.5% to 4.75%. And then if you want to just take a little bit of a maybe additional risk, you can go into a 1-year bond that might get you up as high as 5.25%. So you don't have to just sit on your money and savings not doing anything for you while you're waiting maybe for other opportunities, whether they be in the market or other areas.
And what other strategies do you find most effective when talking to your clients?
Well, that's really helpful because on at least this side, they can, if they are nervous about the market, they can actually layer in a bond strategy or layer in this FDIC-insured CD strategy. Because people like us, we're totally independent, so we can shop those out for the clients. They don't have to just run to the bank, because a lot of times we can actually provide better opportunities for them on a national basis. So we can structure anything like that can just get their money working more efficiently for them. And if they're FDIC-insured CDs, they don't have to worry about the risk, right, so much. So if you're looking at other opportunities, then more sophisticated firms may do options on portfolios to potentially provide some type of buffer out there or a hedge against the market. Well, there's been advancements in what's called ETFs or exchange traded funds, where they can buy a buffered ETF, and it may give them the upside of, say, 18 to 20% or so on an index like the S&P 500, but they're going to protect them on the first 15% on the downside. And these are measured on an annual basis, so they still have liquidity, but they can participate in some of the market. If the market goes up, there's also a buffer there. God forbid the market goes down. If it's greater than 15%, yes, they have to absorb it, but that first 15% can be absorbed in instruments like this.
And you also mentioned dividend stocks?
Yeah, so there's some great opportunities out there in dividends, because people have to understand, like if you get interest off a CD, that's taxed at your personal income rate. But if you have a dividend stock, it's at a qualifying dividend level. For some people, that may be cutting their taxes in half, or maybe, depending on their bracket, may not have to pay any taxes on those qualified dividends. So your total return goes up. But these dividends have been going up in companies, and especially if you looked at some sectors like energy, which has done really well this year. All right, we've had it in our portfolios for a couple of years. Some of these stocks are paying additional dividends this year because all the oil has to do is be over maybe $35 or $50 a barrel, which it has been. It's been coming down, but it's still going to be over that. They have these special dividends that they'll pass through, and people can really take advantage of that if they know what to look for.
So very quickly, what is the #1 question people should be asking their financial advisors right now?
Well, one, make sure they're professional, right? So make sure you are a certified financial planner. But also, in this basket of goods, are they cookie cutter, or maybe are they something that just is pigeonholing them into one or two things? Or are they truly independent, and what can they offer for great diversification, especially in the short term with some of these maybe CDs and bonds that are out there?
Excellent. Always great information, Jim. Thank you so much for joining us. Jim Lineweaver is a certified financial planner professional, and don't miss more market insights from Jim on the Financial Quarterback, leading us into Fox News Sundays. Back to you.